In English, it's Martijn Groot from Alveo. There's some background that I can give about Martijn. At Alveo, Martijn looks after marketing, strategy and corporate development. He has 25 years of experience working in financial services and technology, mostly in product and market development roles, with a focus on information services. Martijn previously worked at ABN AMRO, iGate, Euroclear, with the market and reference data and analytics products and services as a common theme. Martijn also published 2 books on information management and financial services, holds an MBA from INSEAD, a master's degree in mathematics from VU University Amsterdam, and a master's degree in English literature and linguistics from the University of Amsterdam and the University of Leeds. Martijn, the floor is yours.
Yeah, thank you, Jan. Yeah, the last things are quite a long time ago, actually, but yeah, I think they're there for completeness' sake. So, welcome everybody. I'm honored that I can close the last session in the reference data and feeds program of today's DKF event. And it's also nice that we have an in-person event again in Munich after 3 years. So, I'm going to cover a couple of things today. I'm going to talk about reference data, and then from the ESG aspects in particular. I guess I'm not the only one talking about ESG, right? I'll try to make some specific point of view, but it is of course everywhere in other talks, in all the media, given the European Green Deal, the current energy situation, energy crisis, and also a lot of large investors with their public statements, some of the pension funds publicly divesting from fossil fuels and so on. Of course, it has a lot of repercussions and, dependencies on the financial information space, which I guess is the heart of the DKF audience. And we've had a lot of, waves of M&A activity in the data products, as well as new, continuous set of new startups, and a lot of new offerings around primary data collection, aggregation, and how to extract market intel from that. You have consultancies building up their practices. I expect that they will be quite busy the next years. And then you have, I think as a previous speaker from Arenda talked about, you have alternative data sets like sentiment data to fill in the blanks in the corporate reporting record. And there are lots of blanks there, but also to provide a more real-time perspective for certain use cases. So there is, of course, a lot of regulatory pressure and regulatory angles in the news coverage, as if they are for the buy side, people marketing funds in the European Union, as I guess being top of mind, but also the sell side has a number of regulatory aspects, and I'll come to that. I guess the first point I want to make is that the regulatory side is, of course, far from being the whole story, and that there's a number of other angles and perspectives and use cases, hence the title of the presentation, shamelessly paraphrasing somebody else's work. So, I'm going to go into the following. First, I'd like to share some findings about a global buy-side survey that Alveo recently did on where firms are in terms of ESG data collection, ESG data management, what are their priorities, what are their roadblocks in making it operational, what issues do they face, also what sources do they use, what types of content are they using, how are they organized, and what their investment outlook is in the space. Then I'm going to go a bit more into the other use cases that at least we have seen on our clients, buy side as well as sell side. What other, lenses, if you like, or perspectives on ESG data need to be serviced by data operations departments, data services groups, and then lastly, how to operationalize it, given that it's it's not new, but you can say it's becoming mainstream. It has been there for decades, right? Companies like Sustainalytics have been around for 25 plus years. I guess it is fair to say that this has come of age and is now becoming mainstream and is being embedded into, pretty much every business process and all aspects of decision making in financial services. So starting with a picture, doesn't have too many big pictures, so I'll start with a picture to show the classic, data management funnel, data management channel that as people know from pricing data, from legal entity data, and from security master data. So a number of data sources that at least we have seen in accounts. A lot of them have changed hands, are part of bigger groups. I guess every large enterprise data provider has bought at least one ESG company in the last 5 years. So quite a wide and diverse sourcing landscape. Also because ESG, and I'll get to that, unlike, say, other reference data areas on entity level or instrument level, is of course much more rapidly developing, and there's much more variation as well. And then of course at the bottom, I just mentioned some of the corporate reporting frameworks that are out there, but you cannot include there also every use case, every business application, every, say, portfolio management application, risk application, banking system, what have you, that needs to include that, whether it's for client reporting, reg reporting, the loan book management, and so on. So, I guess probably there are a number of issues that need to be cracked in the, let's say, in how you amalgamate and combine those data sets in data management, how you derive analytics. There's more gaps in the public record from companies. Sometimes it looks more like companies, it's their PR department that publishes the data, and sometimes it's really the investor relations group, and they publish a lot of detail ready to be used. So there's a lot of variation in how corporates disclose. But there is quite a hefty challenge in sort of connecting all the dots there. Now going on to the survey and sharing some results, and the full results and the full report will be on our website, but also feel free to contact me and I can send you a copy of the report, which will be published in the next couple of days. First, the sort of demographics. So we surveyed 300 firms, all asset managers, focusing on 3 regions. We had the UK, we had the US, and we had APAC, which was China and Southeast Asia. So to be exact, quite a sort of range of. I see the font is pretty small, but a range of within the buy side, most groups represented. So this is the asset managers linked to insurance companies. So say liability-driven investors or sort of semi-independent sort of mutual fund groups. These are the wealth managers. So say that do the asset selection. We had hedge funds, we had pension funds, some sort of mutual fund companies, and private equity funds as well. So we also touched on the private markets that have their own particular data collection issues. And then different, within those groups, we had front office there, operations, mid office, so the performance attribution, reporting, compliance, business development, so new product development, and client reporting. So we cast a pretty wide net. I'm going to give you some of the highlights. There's some more in-depth sort of zooming in on the different groups in the full report. All in all, I think about 15 to 20 questions about some of the themes listed here, right? Sources, use case priorities, what is top of mind in how they're organized centrally or decentrally or front office only, or all the different flavors. Now, going to the sort of summary of the key findings, and then I'll give a little bit of background and depth to that. Overall, sort of from an asset selection, so the screening of the, let's say, the possible investment universe, including, excluding companies in the mix and zooming in on what is the investable universe, came as the sort of main reason, the main driver for using ESG data. But we had some different, if you look at the regions, there were some different priorities there. Now, regulation didn't come first, actually also didn't come second. It was fairly low down the list. So either firms that have to do it are pretty far advanced with SFDR, right? So the fund classification and the collection of the principal adverse impact indicators. Or they're waiting for if they're not selling into the EU or in the EU, they may be waiting for the next regulation in their own region. But that was not top of mind. We did see new product development. That was the US. Asset allocation was APAC, and client reporting was in the UK, as mentioned, as the top use case, so the top driver behind initiatives and behind, say, top of the agenda of the data management groups. What is also clear is that there are a lot of gaps. I mentioned it already in the sort of corporate disclosures. This was also borne out by other surveys. There was one done last summer by the Irish Trade Association of Asset Managers, Funds Ireland, that actually they did an analysis of nine of the data vendors. They didn't name them, but it was not that difficult to guess. and then they mapped all the mandatory indicators under SFDR, and there were, I think, 6 of the 14 were. The record was very, very spotty indeed in what the data vendors could disclose, because corporates don't disclose it. For example, gender pay gap it's not something that corporates like to disclose, presumably because they think it's going to cost them a lot of money if they report that. So the lack of corporate disclosures means that there's quite a lot of sources that we see in ESG, a lot of different data sources. More so maybe than in pricing or security reference data, where there has been more consolidation and sort of a longer history of the enterprise data landscape. So it's like 9.3, 9.7 different data sources. And if you go to the asset services companies, so the big custodians, they have a lot more, because they have a lot of different requests from the different buy-side clients that may want specific sources for carbon emissions, for example, or that want to use a lot of different rating companies. Certainly, everybody wants to improve the data management. It's very, let's say, embryonic in many cases, leaving aside the sort of people that have done it a long time, like the impact investors that have been around for 20, 25 years. For example, Generation IM is a fund in the US and in the UK that's been around a long time, and that is really a specialist. But for most firms, for many firms, I should say, it's a fairly new discipline, and of course they also have to cater to their investor preferences as well as abide by regulation. Now, when it comes to how the current setup is, there's quite a bit of variation between front office only, so proprietary scores and metrics, the different portfolio management groups, each doing their own thing, to being already quite a sort of mature and sort of centralized within investment operations, a centralized function. When firms look outside, and I'll get to that later, they say the data as a service is the sort of preferred sourcing model to outsource it. They prefer a one-stop shop. Right. So let's go to the data sources. Spoke about it a little already. Very few. These is the like 1 to 2, 3 to 5. The biggest group is 6 to 10 sources, and quite a substantial minority, about a quarter, says 11 to 20. And then you get sort of a group that has more than 20 different data sources, with sort of 9 to 3 as the average. US is slightly higher than the others. Could be maybe be linked to the focus on business development and sort of new product creation. There are different sort of content types that go sort of top to bottom. Corporate disclosure is the rarest, right? Because there's presumably a lot of work to go to all the annual reports and the websites and sort of do it sort of in-house data collection. It does happen, especially if you go to the PE funds that of course have a lot of direct links and control their companies. They get their portfolio companies to do a lot of corporate disclosures, which they again need to show to their institution, to their LPs, so to their institutional investors, pension funds, and so on. Sentiment is pretty widely used. Actually, far more widely used in the US. I think it's 58% than in the other regions. So I guess there's some room for growth in outside the US. And then a lot of people use, of course, third-party expert opinions. Right? They're specialists for carbon emissions. They're specialists for gender pay gap. So for the E, for the S, for the G, there are specialist companies that have their own sort of expert opinion. And then ratings, so ESG ratings is the most widely used external data set. Maybe also unsurprisingly as well. Firms do supplement it with internal data sets, so things they sort of collect directly, or maybe their own opinions from doing analysis or speaking to the management or sitting in on earnings calls or what have you. If I go to the point I made about the regional differences. So there are many reasons firms have to use ESG data other than direct reporting. And I think that's sort of a key point here. But of course, direct reporting has been in the spotlight, at least in Europe. And I've split them out here by region as well. So APAC is grey, then the UK is sort of red, and the US is blue. Going top to bottom. So enhancing long-term returns scores pretty low, right? Maybe there has been a bit of a reality check there that ESG doesn't necessarily mean that you're going to get a better return. So that looks there is some skepticism there. Pension funds, of course, have their own maybe long-term horizon and motivation to go sort of embrace ESG-driven investment. And I think there was a lot of sort of talk about ESG outperformance early on in the COVID pandemic, right, a couple of years ago. But in my view, that has, personal view, has had a bit more to do with the boom in tech stocks that are often labeled under ESG. And of course, the sort of crash in the, let's say, traditional non-ESG sectors like oil and gas and airlines. So I think it's more to do with that than in any sort of persistent outperformance. Reg reporting, you see also here, not top of list. And there are a number of other reasons. Improving overall performance, new product development, as I mentioned, that's the biggest score for the US. Screening organizations, or as an investment factor in asset allocation, is the biggest score for APAC. And then the UK had client reporting. So could be also that was maybe a little bit more also overrepresentation of wealth management in the UK. And by and large, also investors also expect more. Right? Certain groups of investors, certainly next generation, invests more easy reporting from their wealth manager, from their private bank or asset manager. So there are a lot of other differences regionally that those will be in the full report. Now next we surveyed the asset managers on what they encounter if they try to sort of put it to use. They have all these different data sources, all these different types of content. Of course, the crux is to embed it and to properly anchor it in decision making, as there are a lot of different use cases. So how to address those different use cases and what do they encounter? For once, I'm glad to say, and I guess this sentiment will be shared by other vendors in the room, that cost doesn't seem to be an issue. Nobody's looking to cut cost in ESG because most haven't really got started yet, right? So there's maybe not that much to cut, and they need to build up these capabilities. Firms are struggling to get that ESG into their workflows, right, on the different parts in the investment management process, to embed it properly into the decision making. So it has to find its place next to the existing client data, legal entity data, information, corporate actions, terms and conditions. It's mostly an entity data level, but of course there's green bonds, green bond programs. And depending on the level of scrutiny of the specific investor, they can go very deep in detail of how they evaluate, let's say, a prospectus for a green bond program, and often they come to their own conclusion and don't necessarily take somebody else's label, be it MSCI, be it Morningstar, or somebody else at face value. There is a lot of custom data, if only the use of proxies to fill in the blanks. So a lot of sort of in-house made assessments of metrics and scores. And some of the common ESG data challenges, we define those in the questionnaires, but we label them under data availability, data usability, and comparability. And availability is that sort of those gaps in the public record that I mentioned. Some firms, they do report a lot, right? So I was looking, I think last week, at the site of Akzo Nobel, so a large paint company, industrial paint company. They publish lots of spreadsheets on their investor relations portal, and also have already kindly done the mapping to the PRI framework, the mapping to the TCFD reporting framework. So they already put some things in place for their investors. But some other firms it's a little more than a PR exercise, right? And of course, if you go outside Europe, outside the EU, it goes down a bit. If you go from B2C to B2B companies, it goes down a bit. B2C, there's presumably more, let's say, more attention for public relations and for the public opinion, so they do a little bit more. And if you go private markets, it completely depends who their investors are, what they report. Usability, that refers to also disparity in methodologies, especially on the ratings, on the different rating firms. Right? They all have their own input sets, their own models, their own weights as to where they put the focus. Sometimes they focus on the E, on the S, or the G. Sometimes they have an overall sort of comprehensive label. It reminds me sometimes a bit of the sort of food labeling of sort of organic food or green food. It's also all over the place. And consequently, the correlation, I think this is well documented, is that the correlation between different ESG ratings for the same company from different rating providers is is pretty low, far lower than that of the credit ratings, where at least the objective is clear. If you go to credit analysis, you're trying to gauge the probability of default in a certain window, time window. And of course, in credit analysis, you draw on, I guess, centuries of banking industry and centuries of credit analysis, of loan analysis. So there is that, and ESG is I guess, coming of age. So there's a lot of variation in the ratings, which means that if company A says the rating is AAA from an ESG perspective, and the other one says it's a single B, you still may need to go back to the underlying data to make up your own mind and get the raw data. And then there's comparability. Yeah, it's the concepts overlap a little bit. There are different corporate reporting frequencies, right, depending on the financial calendar. So you're not always comparing like for like. And you need to put users on a common footing as well. So ideally embedded in a common framework to have all the financial data historically looked at, and then quickly onboard users, reports, and business applications. Now, in many firms it was a front office focus, initially before SFDR came. Now you have both the pull from investors that maybe have new criteria and a new sort of taste for certain funds or certain sort of boundary conditions on their investments, and then the push from the regulators, mostly in Europe so far. That means that it has to be embedded in, say in research, portfolio construction, performance analysis, client reporting, and so on. Then there's different, say sourcing models, in-house development of tooling, again, mostly front office play, or if you really have a proprietary approach. On-prem is, I guess, falling out of favor. Asset services have, of course, sort of add-on services to their other services they provide to their buy-side accounts. Managed service, so the hosting and the application management outside. And then the next thing, also the sort of the treatment of data, the integration of the feeds seems to be the preferred option. So, lastly on the survey, and then I have, I think, a few minutes left to go over the use cases. I think the investment outlook is, pretty clear. Many firms, they realize they have to cover a lot of ground. There is a ton of work to do, and there are, of course, many different providers in what is, I guess you can say, is a very burgeoning market with lots of different companies offering solutions. Most look to ramp up capabilities actually quite substantially, so increase their budgets quite substantially, and it also seems to be sort of an in-year play. So within the next 12 months, things will need to be put in place, which I guess is good news. But it looks to be a busy year in any event. I think the key is always, I've been on the other side at ABN and Euroclear. I mean, I think the key is always to source wisely and keep your options open and prevent lock-in to any particular supplier. And if at all possible, because the use cases are there, but most likely they will change or there will be new ones. So always try to keep an eye on the future and lower the cost of your change for the future. That's, I guess, the preferred mindset. A couple more things I mentioned it will be pervasive across the business processes, so leaving the survey behind, and some things that we have encountered in also our banking clients as well as our buy-side clients. Buy-side, the sort of proprietary scoring, the client reporting, because clients want more, and if you launch a new mutual fund that's ESG related, I think you have to substantiate that, right? You can't just say, it's a green fund, and people will believe that. You need to show what it actually means. Then, of course, firms are creating their own products. So often that can be large-scale data analysis, sort of large-scale data warehouses to sift through tons of data. And I think reg reporting we talked about. And of course, ESG comes with our own indices, their own benchmarks that performance will be tracked against, right? If you want to do a like-for-like comparison, the index and benchmark market will develop in parallel. Sell side, same thing, different use cases. There's the client onboarding with questionnaires. If you become a new corporate client, there's a green asset ratio. Banks will have to report on the composition of their loan book. So if they do general purpose lending, they have to report according to their, let's say, the EU taxonomy. What is the revenue mix of the companies they lend to, and report on that. So they need to know a bit more about their clients, not just the traditional money laundering, anti-terrorism, but also what is their business, right? What is the mix of the revenue mix? Same for the residential real estate, so the commercial, the property books. Things like flood risks that might have been more linked to reinsurance companies also make their way into the banking books. And then there's the climate stress test scenarios. The ECB has it, the Bank of England, MAS in Singapore. Another perspective on ESG for the banking and trading book. And then this is not unique to banks, but I guess for everybody, know your supplier, know your third party. Also, what is the ESG behavior of all your suppliers? Then I'm going to wrap up. Not sure how much time I have, Vivian. A few more minutes, okay. What is required? So what do we conclude from this? So it will take a while for corporate disclosures to be consistent and pervasive. Right? There is the CSDR in Europe, not covering all the companies. I guess it will start at the big publicly listed companies and then hopefully make its way down. So for now, you need to combine different data sources, and often we'll need to go back to the underlying data. That's a reality, and sometimes this can be quite a large set, depending if you are servicing multiple institutional clients that might have their own requirements. Integration needs to cover the required data sets for different use cases. It's not just the SFDR perspective. That it would be simpler because many data providers, they have an SFDR overlay, so they try to cater to all the different metrics that are needed just for that use case. But I think fair to say it will make its way into most aspects, if not all, of decision making, and be properly integrated with everything else in pricing and reference data. So that's linkage, hierarchy between issues, issuers, ownership structures. You will need the capability to track and trace. Again, that's something that we also see in other data categories, both for content licensing reasons, but also for regulatory reasons. And I think also as a company, as a data operation, you want to know what data you use and also what data you don't use, so you get the maximum ROI on the data that you source. But also to explain decisions and replay decisions and how you came to certain numbers. Data quality is important. There's big gaps. There's a lot of disparity in different data sources. So it's going to have to be monitored pretty closely. And then to make it really productive, it's quite a daunting integration task to get it into all these different business applications into the hands of the different stakeholders. Right? If you want to put your organization, as in every other data set, on a consistent footing and facilitate the access, make it as easy as possible to get your hands on the data, and at the same time also controlling who can do what and who can change what. I guess data governance in a nutshell. So that's what I wanted to share today. We're Alveo, leader in cloud-based market data, reference data integration, and data as a service solutions, servicing clients around the world, buy side, sell side, insurance, market infrastructure. And we cover pricing, time series, risk data, corporate actions, other reference data. So ESG is something we've been looking at the last years, adding our sort of standard integration library with lots of new data sources, adding to our data model, and also adding to our integration capabilities to make sure it's dispersed and sort of made operational as quickly as possible. So we'll share the full results on the survey on the website in the coming days, and we're exhibiting here at the event. So thank you very much for your attention.
We're not going to have questions, I'm afraid, because it's exactly, it's 40 minutes past 3, and it means that the last panel discussion will take place in the big room. So for those of you who want to attend it, please make your way there now. And there's also a KVG roundtable, if not mistaken. Not exactly sure where it is, but that's also starting now. Thanks, Martijn Groot, for your presentation, and see you later all.